Everyone says buying a rental or have a business idea, start with an LLC. But is that really true, or could it actually make things harder where you're trying to buy and finance property? Aloha, it's Deep. Today we are breaking down one of the most common questions I get from investors. Should you hold the property in your own name or under an LLC? I'll walk you through the pros, the cons, and the key things to keep in mind about taxes, financing, liability, especially here in Hawaii. By the end of this video, you will know which route fits your goals best. Full disclaimer, I am not an attorney or CPA. Please consult your attorney or CPA to find out what fits you best. All right, let's get into it. An LLC or limited liability company creates a legal separation between you and your property. Instead of you personally owning the home, the LLC owns it, and you own the LLC. The idea is liability protection. If someone gets hurt on the property or files a lawsuit, they go after the LLC instead of you personally. But that protection only works if you keep your books and personal finances completely separate and have the right insurance in place. It's a layer of protection, not a magic shield. The benefits of owning under an LLC. There are some real advantages. Liability separation is a big one, but organization is another. When you own property through an LLC, it keeps your income and expenses neat for tax purposes. You can still deduct interest, repairs, depreciation, but the paperwork stays within the business. For investors with multiple properties, each LLC can isolate risk and make bookkeeping cleaner. It can also offer some privacy. Public records show the LLC name instead of yours. Here's where people get surprised. Financing under an LLC is much harder. Most residential lenders won't lend directly to an LLC, which means you usually have to buy in your personal name to get the best rate and term. Loans under an LLC often require bigger down payments, shorter terms, and higher interest rates. Plus, here in Hawaii, LLCs come with annual state filing fees, accounting fees, and administrative costs. If you only own one property, these fees can add up fast. Taxes and depreciation. From a tax perspective, the difference isn't as big as people think. Whether you own personally or through an LLC, you can take the same deductions for the interest, repairs, and depreciation. The only change is how it's reported. When you own personally, you report it on Schedule E of your tax returns. With an LLC, profits and losses pass through to your personal taxes anyway. So from a deduction standpoint, you're not saving extra money just because you formed an LLC. Lenders care about you, not your LLC. The company itself doesn't have credit or income, so you'll usually need to qualify personally and sign for the loan. Some investors try to buy it in their own name and transfer the property to the LLC later, but that can trigger the loan's due on sale clause if the bank notices. Before you move title around, always check with your lender so you don't accidentally violate your loan agreement. Another issue is to keep in mind is title insurance. Most title insurance does not cover quitclaim deed to an LLC. Make sure your title insurance covers you even after you transfer your title to an LLC. One of the benefits of owning rental property is being able to use its income to purchase additional properties. Real estate lets you deduct your mortgage interest, depreciation, etc. as losses on paper for tax deductions, but does not consider those as expenses when you qualify for a loan. With an LLC, because it's a business loss, they are considered as actual loss in your K-1 form. The key moment is realizing that an LLC is just a tool. It's not required to be successful in real estate. If you are just getting started or buying a primary home or first rental, keeping it in your personal name can be simpler and more cost-effective. Once you start building a larger portfolio or bringing in partners, then an LLC starts to make more sense for structure and protection. So here's the bottom line. Owning property under an LLC can give you organization and some liability protection, but it also adds cost and complicates finance. Owning personally is usually simpler for first-time investors and still lets you take full advantage of deductions like depreciation and interest. Talk to your CPA and your lender before you decide which path fits you best. If you found this helpful, watch my video on scams to watch out for after buying your home. It's another way to protect your investment and avoid costly mistakes. Mahalo.